Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone, and I'm Ira Epstein telling you the risk on trade on Thursday, September 15th, 2011 is back in play. Safe haven mode, out the door. Why? The European Central Bank found a way to work with the Federal Reserve, the Bank of England, the Bank of Japan, getting these banks together to help out and get dollars, if you will, exchanged with the ECB. I'm not convinced this is a loan. There's a swap going on. Individual banks, because they're under so much pressure in Europe, are having a hard time getting dollars. ECB, a very different story, and instead of them doing it a week at a time, they've stretched it out to a 90-day interval, and there's going to be several of these going on. Now, you'll read more about it in the newspapers, but what it does is it allows dollars back into the system, and that's an important event for a lot of the banks right now in Europe. So, you took the bonds, the notes down. The stock market's had a stellar day, a good hard rally. In fact, you're at the highs of the day in the S&P. You're honing in on it in the NASDAQ. You're going for it in the Dow as well. You need the Dow to get up, in my opinion, about 11,400, right in that area. I'll be pretty excited about the market at that point, saying, okay, it's seen the worst. As that happens, your euro has taken off 137 points higher. Of course, the Swiss is back up to the 115 area. And remember, they're not letting it go over a 120 peg. It'll be very interesting to see how that works out. And of other markets, well, lower dollar often brings up other markets, not all of them. And the lower dollar will act as something of a cushion now for the gold. I realize gold's still down $33, but it was at $17.75. It's almost $20 off that low. So let's look at the gold chart and get an idea as to what happened. Some market technicians are going to say that the market made a double top up here in the 1905 to 1917 area. Okay. Other technicians like me are going to say the market's caught in a trading range, still from this area. You slightly went to 1917, but you still got that 1705 zone. Other technicians like me will say that today was an important day, and that what the market has now done is you've got successively lower highs. 1848.20 is under this high here. This high is under the 1917, and certainly today's low at 1775 took out 1794.80, which starts a pattern today of lower lows, because this low was higher than that one. So we've got lower lows and lower highs. I call that a bear market pattern. Next, I look at where is the 18-day average of closes. This happened today under the 18-day average of closes. And for those of you that get my medal report, I wrote about this event yesterday morning. 4:30 in the morning, I got in the office on Wednesday, began writing this, had it published, I think, at 7:30 or 8 in the morning. And here's what I basically said. I said that I think that the key was not taking out 1794.80. This is yesterday's action without taking out the 1794.80. For a bull market event to develop, I would have loved to have taken out the lows of yesterday, 1811.5, not taken out 1794.80, and see the market turn back up. Why am I looking in the bull market area, not the bear? Simply because the seasonal studies are still bullish. Don't know if they're going to get run over or not, but the seasonals kicked in, and I've been keeping track around the 1830 level. So today they're under pretty good water at 1792. That's why you use charts. Let's take away today's action and go to yesterday. You still have a market that's making lower highs and higher lows. And on the gold report that we have, what I did is I drew in how that's narrowing in, and it was forming, if you will, a triangle. And which way was the market going to break out of it? I didn't know. I know I don't want 1794.80 taken out. That was the one number I wrote about. And so where are you now? Well, today you've taken that out. So I start looking at where are the next support zones, since without taking now 1848.20 out again, you're in a short-term downtrend. Just plain. That's the way it is. 1737.10, the 45-day average of closes, is one of those numbers, and 1753.90, the Bollinger Band, is one of them. So the higher of the numbers is the Bollinger Band. Let's call it the 1754 area. And if the market wants to leak away, that's about where I'm looking for the first area of support to come in. Another problem is the market's breaking down, the Bollinger Band's dipping. I think you can see that a little bit. So the number can go a bit lower than that before it's all said and done. Okay, so I look back here, and I go to the end of July, and I keep looking at this number, the 16.25 area. Very important to me. And you'll say why. Because I've done studies, and I published them in my newsletter, as to the percentage of times from that number by year's end. I'm not interested in this. By year's end, will the market be over that number? And to me, that is one of my big lines in the sand. I consider that a big-time area because the percentages are so lined up in bull market years. And anything you want to do, call this a correction. I don't call it a top. I don't think that Europe has resolved itself. The United States, you got to be kidding. Things are better. Did anybody bother looking at today's data? You have an FOMC meeting coming up. All you do is get through one hurdle. The market then comes down. The real break in gold did not happen today. The real break in gold, so you'll all know, was here. And this is back on September 7th. And because the market broke the pattern at that time, and even though it held the 18-day average, you would change the pattern to one of a lower low. You had to go up, make a new high. You didn't. Here's the 12th, and this is what's really occurred in the market. So you're just paying from that point in time. And there's people caught up here, way too bullish probably, so they've got to feel a little bit of pain. The bulls in the gold haven't learned at this point that if you buy too high, you're going to have to go through some pain. Up until just recently, anything that they bought, the market went higher. Now you're getting the distribution of the market, and that takes a while to, if you will, work itself out. So I still feel the 1754 area is the support zone. The market is not oversold. There's still downside momentum left. The silver market could be a little bit different. It's number one, in a bear phase. Number two, it's getting oversold. And number three, I was only looking for the Bollinger Band to get hit at 390 at 39.2770. Today's low is 39.40. You're very close. You can get down there, but you're getting close. And being in oversold territory, I'll bet that the market wants to look for a support zone. That's all I can say. Remember, here's your Bollinger Bands. You rarely stay under them, and you rarely stay over them, and you're approaching one of those bands now. In the copper market, I keep saying this is an area of support. Whether it holds up, I don't know. But I actually consider this whole area from the low 380s, and today we got to 389.40, not the low 380s, back up to 429, your overall plateau area. If world economies were to pick up, I'd look for copper way up here, way up there. If world economies collapse, this whole area can become a top, but it's neither yet. You're now testing this trading area back and forth. It's a trading market that has a downside bias. It is oversold, and it's hit the Bollinger Band twice and been turned away from it. That's my definition of it. In the crude, as I said, the crude and the stock market are still tied. However, the crude oil, if you heard my other report, one of the things I'm starting to point out is it's losing its momentum with the stock market. Up until just recently, for the past 60 days, 90 days, it's been a proxy for the stock market. Now they're starting to separate, which is even more bullish for stocks because high energy prices are what? A tax on economy. So I'm watching this. It's in an uptrend, resistance to $91 area. I'm watching Brent, which is really the world grade of energy. It's in a clear uptrend. Once it took out, and you tell me, I'm going to show you this. Here's the market yesterday. You had to take out this break low to get bearish. You didn't do it. If you get through 111.30, you're bullish, but more importantly, if you take out 112.70, the high of yesterday, and don't take out 110.83, I think the pros were going to buy it there, and they're going to look for a pop up to the Bollinger top. That's what I think was the most likely event to take place, and darn it, you didn't quite hit it, but you're there. Why do I think that event was good? The setup here is so different than it was on the WMI, but no matter how I look at it, was a $2,000 risk. Even if you used, and I don't know that there's a Brent mini contract that is viable. I know there is one on the WTI. But you couldn't cut that risk down, and that's the problem. And, risk to me is what everything's about. Rebob gasoline, I like what it did today. It ended the downtrend. It took out this break low, the high after a break low. It's back up to fighting at the 18-day average. Today, let's see, the high is 280.71. The 18-day average, 279.98. So the market is now got what? Neutral bias. It's out of its flung, if you will, that fling to the downside. And again, if world economies are going to get better, I think that's what people are saying. Maybe you don't want to be short too much of the energy. I'm Ira Epstein. We're ending here. Remember, it's the Gold Report if you'd like to get a copy.